All right, sorry, here we go. All right, so we're going to talk about a warning from Blackrock, and I think it is very important to say that Blackrock, JP Morgan, Wells Fargo, those guys are like the smartest guys in the room. It's because they are. They have the most information, the most data to compile together to come up with their outlook on the future. And they always like being right, just so you know. They like telling you in little tidbits the reality and the future of the economy, and they have given a very serious warning. I too have been talking about this very phenomenon on the last few weeks of this channel and on the Economic Ninja channel about people getting way too excited about the Fed lowering rates. It is absolutely blowing my mind. This is what is causing gold to go up in price, silver to go up in price, Bitcoin to go up in price. Everyone's positioning themselves in a position where, oh, the Fed's going to lower rates. They're not going to. Check out this warning from Blackrock and then think about how this is going to affect the price of gold, silver, Bitcoin, the stock market, as I believe the stock market also is going up because traders are believing that the Fed's going to pivot. And think about when they figure out they're wrong. Now, I've already given my idea. If they do lower rates next year, there's a certain type of verbiage that they're going to put out that we know that this is a false narrative, that they're lowering it for political reasons so that people will vote a certain way. By the way, I put that out on the real estate course too, so everyone that owns the real estate course, go take a look at that, the how to prepare for the crash course. Also, somebody asked me to put some links to just the 80% off the real estate crash course for $199. That's below. I put a few links below if you want them. Cool. If not, no worries. Here we go. This is out of Yahoo Finance and Bloomberg. It is entitled, The Story, Blackrock Warns on Rate Bet Disappointment and Volatility in 2024. So here we go. BlackRock Incorporated says market optimism over the scope of interest rate cuts next year may be going too far and recommends stepping back from longer maturity bonds. Let me stop there and explain this. Banks have a lot of unrealized gains, quote unquote, because they bought a bunch of bonds at much lower rates. And now as rates went up, they skyrocketed actually, even way beyond what the Fed wanted them to do, intended them to go. The value of those bonds dropped. Now, a lot of people are screaming and jumping up and down that rates have dropped. They haven't. Rates are simply at where we were in September. So do you feel any richer that rates have dropped? Type 1 if you do, type 2 if you do not feel any richer. Are you that much more excited? Do you think that the real estate market is going to go start screaming back up because now mortgage rates, what are our mortgage rate right now? 30-year fixed, I'll bet you is like 6.4, 6.2. Let's even say it's 6. Do you think, are you just super pumped right now? No, you're probably not, unless you're getting ready for a crash, in which you are. All right, here we go. It says, while some traders are positioning for the Federal Reserve to start cutting rates as soon as the first quarter, even though they're saying they're not, like, think about this. They're like, we may even raise. Nah, they don't mean that. No, we're going to raise. We're the Federal Reserve. We may have to raise. For sure we're staying the course 2024. Nah, they don't mean it. Like, this is where markets go loco. That's different language. All right, here we go. The BlackRock strategists expect the easing will only begin in the middle of the year. We see the risk of these hopes being disappointed. Strategists including Wiley and Alex Brazier wrote, higher rate and greater volatility define the new regime. In that environment, the asset manager prefers short and medium maturity bonds as a source of income, but is staying underweight long-dated treasuries in its strategic allocation according to the 2024 Global Outlook published by BlackRock Investment Institute. As rates are expected to remain above pre-pandemic levels, BlackRock has also downgraded its longer-term strategic view on developed market stocks to neutral, citing rich valuations, supposed to say risk valuations, and the weak economic outlook. It's still keeping an overweight stance on AI-related companies. They go on to say that markets are swinging between hopes for a soft landing and recession fears, they wrote. This misses the point. The economy is normalizing from the pandemic and being shaped by structural drivers. The disconnect between the cyclical narrative and structural reality is further stoking volatility. Supply constraints caused by geopolitics, shrinking workforces, and as a result of aging populations and the transition to a low carbon economy are driving changes that will result in lower growth, inflation stuck above official targets, and increased uncertainty, Blackrock warned. Now that would be a positive for gold, uncertainty, but to be honest with you, this run-up that we've just recently seen, I think is not really sustainable as soon as traders figure out that they're not going to pivot, okay? That's creating the kind of environment where active managers will come into their own, the strategist said. Now they go on to talk about this being out of sync. Still, the recommendations might look out of sync with recent market moves. Stocks and bonds, whether long or short dated, have rallied. Volatility has tumbled as traders embrace the narrative that the Federal Reserve is finished raising rates. Now the focus is on when the Fed starts cutting and by how much. Traders have piled into rate cut bets over the past few weeks as data showed inflation is easing and the economy is slowing. Money markets currently imply that the Fed will start reducing rates in May, with pricing showing it, and the ECB cutting by at least 125 basis points next year. Now let me stop and say that when it comes to the ECB in Europe, Europe is already ahead of us as far as a collapse. Germany is slipping into a fast-moving recession. They are actually in crisis mode, and that is a term from the vice president of their central bank, okay? Again, remember, Germany fell into a deep, sharp recession in 2005, taking us down with it later on. I've been telling you for 3 years that you are going to see Europe fall first, and then we are going to quickly follow, but between 8 and 12 weeks behind, just because of how closely tied our economies are. So Europe is in that official decline. I still believe, though, that we are way beyond that. Like, we're not there yet. Another thing, too, is that it's insane where the government comes out and tells you that a Thanksgiving dinner costs less this year than last year. That's a straight up lie. Go to the grocery stores and you'll see it right there. That's not the case. When they tell you that inflation has dropped, we all know that is not the case. Now, it says here that soaring U.S. debt burden is another reason to avoid long-dated treasuries, Blackrock says. If borrowing costs stay near 5%, in a few years, the government could find itself spending more on interest payments and healthcare benefits, the strategist wrote. That could lead to entrenched inflation and stumbling growth as central banks struggle to respond to a faltering economy with the aggressive rate cuts as they did in the past. This increases the long-run risk of higher inflation as central banks become less aggressive on inflation, the report said. We also see a rise in term premium, or the compensation investors demand for holding long-term bonds. So the point being is that we are in a spot where BlackRock, and myself, I also believe the same thing, these bets on the Fed lowering rates are way too premature. Really, remember, in the past, it's always been a big move in the stock market downward, a correction in the stock market, a really deep correction in real estate. And really, if you think about it, they don't really care if real estate drops really far, too far. It's the stock market. You see, when everyone's looking at the stock market gains, so the returns on their investments, their 401ks, especially in their retirement plans, that's when people start to get really scared, and that's what the government wants to prop up. Why would the government want to prop up and encourage the Fed to lower rates? Well, it's because we've all become slaves in this modern day system of pensions. You see, we all are FOMOing into putting money into the government, letting banks and the government officials have our money interest free for 20, 30 years, in the hopes that we're going to get something back in return at the end of that, right? All of this is for a tax write-off. So we're giving them our money to save, 30 cents on the dollar for every dollar we invest in these funds, hoping and praying that these things go up in time for us to retire. But what's interesting? I know people that retired right as the dot-com bust had happened, and it broke them. I knew people that had just retired as the Great Recession had gripped and their stocks had fallen by 50%, their retirement funds, and they were forced back into the workforce. So it's really interesting to me when you watch, you know, the stock market and people like feel rich. That's all it is a you actually pull the money out. You know, where are you? Most people that are retiring, not all of them own their home. There's a lot of debt still involved. And so with that debt load, that burden on the average family, they have to maintain good gains. I'll give you an example. CalPERS, one of the largest pension funds in the country. I think it's the largest state pension, I believe. They used to need to maintain an average yearly return of 11 to 12% just to stay solvent, just to keep their beneficiaries, their current beneficiaries, paid. And what's happening is that pension system is actually collapsing. And the way you know it's collapsing is the Ponzi scheme gets worse. It costs you more money in CalPERS to retire at a certain amount, and your benefits are decreased as they hire new people. It used to be, what, 3.5%. Then it was 3. Now it's, I want to say it's 2% now. Let me know down below if you're with PERS, what the current deal is with them. But I hope you get something out of this, because gold's flying and everyone's super excited, and it's neat. Do I believe we're going to see much higher gold price in the future? Yes. But do I think we're going to see a price dip before that? Yes. So I'm not selling any gold. Am I buying at this price? No. Will I wait till it retraces back down to 1900? Yeah, sure I will. Silver, I think, still looks amazing, especially when it comes to junk silver. But again, I'm not FOMOing into this. I'm looking at the longer term trend. And remember, the only reason rates are going to go down is because things are crashing. So I still see so many amazing deals coming in the future as we get higher rates and we see more real estate deals. If you guys want to take advantage of the how to prepare for the real estate crash course, 80% off right now. I'll put the link down below. For today, if they're out, they're out, but it's $199. With that being said, I thank you so much for watching. The Real Estate Ninja is out.